Good afternoon to all of you, and thanks for joining in to this webinar. Uh, Myself, I am Sameer Chabra representing DBS Bank in India, and I would like to welcome all of you to the webinar of DBS Treasures, the first one for the year 2026. And, in order, while we were deliberating, what we would be discussing, and just to set the context, we deliberated quite a bit in terms of what was happening and what did we want to discuss, starting with, multiple events that have taken place. We thought through and we decided maybe this is a year for rejuvenation of India's economic, landscape. And so we named it as such. And to have a larger discussion around it, we have invited two very eminent panelists, two very, very well-known and expert personalities in their own domain. So without much of further deliberation, I would like to go through their, introductions. Uh, First, we have Mr. Nilesh Mody. Mr. Nilesh Mody is a senior partner in KPMG India. He is a partner in the direct tax practice and has over 2 decades of expertise in corporate taxation, international tax treaties, and regulatory policy. He is regarded as an authority in tax relationship between India and the global economy and a specialist in global value chains, advising multinational companies on cross-border structures, permanent establishment, double taxation avoidance agreements, and a whole lot of the you know uh, cross-border kind of advisory that a lot of companies today who are looking to do business globally need, is where Mr. Mody steps in. So, we thought it will be a very important hand in giving us a picture on the opportunities that are available to Indians globally, domestic as well as NRIs. The second personality I have is a little closer home to us. We have Miss Radhika Rao, who is our economist. She's been, an old hand with DBS Bank. She's a veteran analyst on the Indian economy, and she looks at the fiscal policy, the global macroeconomic trends. She is a frequent speaker on multiple platforms and forums like Bloomberg, CNBC, Economic Times. She covers India, Indonesia, and Thailand, giving a unique perspective to what's happening in not just India but the entire region. And we thought, she's probably our best bet in terms of covering the macro picture on India and the kind of economic opportunities that this presents. So, without further ado, I will, you know, have the first go at my questions at them. And the first one, I would like to start off with Nilesh Mody. And here goes. So, Mr. Mody, one of the first things that happened recently, of course, in a series of events with the budget and the two free trade agreements, we saw, some reference to the new Income Tax Act coming into place, right, from 1st of April. Now, in from your perspective, what are the three or four things, or what are the top things that you see as a major change or shift away from the old regime, which is relevant to investors and businesses alike? So, some color on that for our starters. Over to you, sir.
Sure. So, firstly, Samir, thank you for your kind words. Firstly, thank you for your kind words. And this is my second consecutive event with DBS. So, uh, really enjoying this interaction. Uh, just on that, see, the first act which was there was 1922, which was then overall at 1961, in the year 1961. And this is the third act which is coming as a replacement. The theme of the text is simplification, simplification in process, and simplification in the terms of the way it is worded, right? For example, I'll just give a very simple example. When I joined and enrolled as a chartered accountant in chartered accountancy, like I used to always get confused. What is this previous year? What is this assessment year? So if this is the year 25-26, for tax purpose, it is treated as a previous year. Why not current year? Why not current year? And for next year, it is treated as an assessment year. I think some of those basic language simplification has been done in the current act, which treats which simply treats it as uh, tax year. So the current year is treated as a tax year, right? So yeah, just 1 second. I think the video has got disconnected. Sorry for this. Okay, so that is one aspect. Second aspect is in terms of whatever has been the precedence in terms of judicial Supreme Court decisions, High Court decisions, circulars which has been issued, which are pertinent and related to the old regime or old tax. Now, will they continue to hold good when we are interpreting new law? I think that is something which will get tested and we'll come to know as we move along. But that is in your language a blind spot for everybody to get to that. And then, of course, there is a lot of emphasis on com- technology-driven compliances, making use of AI and so on and so forth. While these are, of course, welcome changes. Um, is this system adaptable today to immediately roll that over? And will there be issues, whether it is TDS reconciliation, TCS reconciliation, or the income tax correlation, and so on and so forth? So that is again one blind spot which I believe it will get tested as we move along. And one last thing before I close this point, this whole push about moving to a new regime, right, for all the companies. Again, one element which the government has declared is this MAT credit aspect, right? That whatever is the MAT credit today available to the companies or corporates, uh, henceforth it will lapse unless they move in a new regime. And if they move in a new regime, 25% of that MAT credit will be allowable against the tax which is payable in the new regime. So I think in some ways, government is pushing towards transitioning towards new regime for the corporate, but it has its own nuances for specifically infrastructure companies and power companies and so on and so forth, which are into old regime and relying on MAT credit to create a tax efficiency at a shareholder level, even for rating weight. So that is one challenge which we will see as we move along.
Good, thanks. So you mentioned that there is some accent towards modernization through using technology. Is this going to be helpful for the mid-sized and the smaller corporates and micro? The smaller it gets, the more are the hassles of tax compliance and adhering to what are the norms. Do you think the newer regime and with their emphasis on modernization will help that, or will it add to the challenges?
I
And
believe that
secondly, if I were to, throw it open to even Radhika, do these things actually help in India being recognized as a place where the ease of doing business really goes up for the larger investing community? So first, Mr. Modi, and then maybe to Radhika.
sure. So, Samir, I think there are lots of places where we see government effort to reduce the compliance. For example, they have reduced the TCS rate of LRS from 5 to 2. They have reduced the TCS rate to 2% from 20% for tour operators for a tour and all that, so on and so forth. So, I think there are rationalization at a TDS, TCS, and other procedural aspects for sure. And if we link it to the modernization, digitalization construct and the faceless assessment and the long-term vision of the government, I believe this should gradually improve the compliance. So we also see by way of data. So, short answer, yes. I think these are all welcome steps to improve and get us in line with the new era. Over to you, Radhika.
Yeah, thank you so much, Mr. Modi. Thanks, Samir. Thanks for the generous introduction. So just to take on what Mr. Modi mentioned, and I think uh, improving business, ease of doing business is just not this budget's take, right? It's been something that's been very front and center, at least for the last, I would say, 7, 8 budgets. And I think it's becoming much more focused now. And one important takeaway from me, personally, is that it's becoming a bit more sector specific. I think that's very important because I think from the government there's a recognition that you can have some broad-based moves, which one hopes that it will benefit A sector and B sector, but I think they're going more nitty-gritty, more granular. If you talk about the semiconductor industry, electronics, defense, textile hubs, and it's an entire mix from labor intensive to capital intensive. Data center based cloud services. So services, goods, more sector specific, agenda. I think that's certainly much more welcome because then it tells you those kind of businesses that are looking for alternate offshore centers or are looking to I would say move in the region, they kind of can find a home when you have a very clear focus area on them. On a much broader note, ease of doing business, I think there's no one thing that really ticks the box. I think there's a series of events, I would say a series of things that can be done, all the way from investor onshoring to making sure that they're able to set up. And I think that's where the bigger picture changes have come in. We have seen, the capital expenditure budget, which is basically bulk of it is going into infrastructure, which is at about a record high of 12 lakh crores. If you just talk about the infrastructure industries, ministries alone, it is about a 17% increase. If you talk about other capex of some of the state, it's about a 19% increase. So again, cutting in many ways, but that is very, very important at front and center supply side push that's being done. And I would say the other one was the customs rationalization. I think Mr. Modi might be an much known area for him. There you have actually seen that so many of the manufacturers have heavy imports. Sometimes you end up paying more on the imports than you are on the exports. So kind of rationalizing that, making it easier, duty free or lower duties to attract these kind of eases the entire manufacturing chain. And finally, I would say the entire piece, right, from your application process, trying to centralize that to environmental clearance, to land, to labor. Labor is another thing that was very welcome, not in the budget, but outside of the budget, where the labor codes were announced, kind of condensed multiple regulations into these 4 big chunks. Yes, I think the industries are going to see a bit of an increase in their labor costs. So cost of doing business is going to go up a bit, but again, it's rationalization, making sure more sectors come into the formal sphere. So it's a kind of roundabout way to answer your question. What I wanted to emphasize on is that there is a broader perspective to improving the ease of business, and there is also a sector specific take. And I think that's what the budget really shows us. And then the final point being, many things are happening outside the budget as well. So I think it's a very ongoing agenda, so to speak.
Thanks, Radhika and Mr. Modi. So, just taking off from the broader discussion that you've just had, so there's been some tax rationalization, in fact, some preferential tax treatment given to some of these specific sectors, as you mentioned, apart from, of course, the broad outlays that they've been uh, given. But we are also used to the fact that there are certain procedural delays and there are infrastructure problems also that they have faced, and which is why semiconductors, while it's been a sort of a mixed bag, we are still not there quite as much. There is also other international centers, let's say, in many industries. Now, will this incrementally make it even more, the tax break and the outlays and the specific targeted focus on some of these sectors, on semiconductors, on defense and all, does that make it more juicier for, let's say, the international investor, for the NRIs to be looking at these sectors and India in general?
Would you like me to take that, or Mr. Modi?
Yeah, sure.
Okay, let
Radhika.
me take a very quick stab at that, and then perhaps Mr. Modi can add as well. So, talking about semiconductor industry in particular, it's not a very easy industry to set up and run. It's a very capital intensive, resource intensive industry. Most of the countries have kind of, after coming out of the pandemic, beginning to realize that there was too much dependency on one geography, one industry, right? So I think there is an effort to make that building capacity kind of redundant. So build more of that capacity going across different geographical locations. For India's case, I think the government did a very proactive thing. I think, if I remember correctly, 24, 25, they have 5 to 7 concentrated JVs between foreign companies and local companies trying to set up. And because out of that, you've actually got, I would say, very active players in the semiconductor field which are coming out. I think the lowest hanging fruit in the semiconductor value chain are what we call OSAT, right? Which is basically the last leg of the manufacturing cycle, which is testing and then packing, and that's where it begins, and then slowly then you move up the curve. I think OSAT facilities have already been set up now. If I heard the minister correctly a few weeks back, he had mentioned that now we looking more towards the fab end, the fab facilities. That's where much of the attention is going to go, but that involves a lot of gestation period. So I think 4 5 years, and we will have that kind of facility as well. And my last point is that this industry also needs a lot of capital support, and that's why I think this India Semiconductor Mission 2.0 becomes quite important, because again, a lot more capital support by the states, by the center has been coming through. That makes it easier for the investor to set up the facility. I'll stop here and on
Okay.
to Mr. Modi.
To take it to Mr. Modi, I would sharpen it a little further to say that, okay, these are the, steps taken by the government, and, it's been incremental, not just focused on the budget. But let's say if I were to be an external offshore investor, whether it's an NRI or a foreigner, what are the things I need to be uh, aware of, wary of, and looking forward to if I were to look at exploiting these opportunities which are emerging out of India, specific to, let's say, the semiconductor industry, the data center industry, which is another favorite with the government this time. So, how do you see that?
I think there is a lot of emphasis this government has always been making for forward-looking business, I would say, whether it is tech-driven, whether it is green energy, and so on and so forth. Now, just talking about semiconductor, India, I think Radhika mentioned that India launched the semiconductor mission in, I guess, 21, 22, somewhere around that time. Uh, and the state government as well as the central government has provided subsidies to set up such semiconductor industry. But for any industry like semiconductor to survive and thrive, it requires capital, which I think has been addressed by the state incentives and central incentives. And the second portion is to attract talent to make it feasible, right, for such that. And for that, in this budget, what they have said is that any global participant who is visiting India, right, for the next 5 years, whatever they earn from India is not taxable at India, right? I think that is a big boost, which will complement the capital incentive which has already been provided by the government. So, in that sense, they have balanced now the other leg of the whole aspect, which is the talent part of it over capital. So that is as far as semiconductor and now the second aspect which you just touched upon was the data center part. Again, that is something which the government has been eyeing specifically in competition with the other Asia specific countries like Singapore, Vietnam, and so on and so forth. And again, to boost that, they are saying that to all the global players who are looking at supplying in India. They are saying, come set up through an intermediary in India and we'll provide you a tax holiday. And that is not immediate, but till 2047. So that is the kind of stability which they are talking about. And then there are other factors which will become important, as Radhika mentioned. One is the tax aspect, but the other aspects are now how do they address when it comes to data center, power stability, the so there are other nuances which I'm sure they will address as we move along in this. But as far as the policy decision goes, they are moving in a direction where they are trying to incentivize through tax and then getting into the other economic areas or policy decisions to make it a circle so that we attract the right kind of organization into us.
Thanks. So that would, I would imagine, also include some good entities coming into manufacturing also, because they've focused very specifically on toll-based manufacturing as well, where they've given tax breaks to non-resident entities coming there in that space.
Correct.
And so, that probably takes care of the taxation aspect. But again, manufacturing, as we've seen, particularly defense, has so far been, in the dominant space has been the government, right? Do you think these things are enough to attract, uh, global talent or global majors getting into even for things like defense? Or what specific areas within manufacturing do you see, uh, getting attracted to India as a hub for, uh, setting up here? Uh, Over to you, Radhika, if you could probably look at it from the business angle, and Mr. Modi from the, regulatory angle of it.
Sure, I'm no sector expert, but I can just take a stab at it. I see the nature of defense, the way the defense industry, at least efforts to localize it, began by I think putting I would say a proposal to say 50, 60, 70% of it should be indigenized, right? So I think that was the initial, I don't think the ratio was that high, but that was one of the ideas, is to make a proportion of the defense equipment localized. And I think over time, there's been an effort to move up. You talk about warships, or you talk about arsenal. It's much of it is being made, at least begin to be made locally as well. And apart from that, there is also an effort to buy from the main trading partners that we have. Now, for example, Russia is one such example. In fact, from the US as well, there's this talk about buying up more, not so much defense, but commercial aircraft, for example. So I would say this kind of a sector needs a lot of security apparatus, right? So I don't think it's a quality, and the security is extremely important. And I think from that point of view, establishing and maintaining relationship with some of the European countries and Russia and all that makes a lot of change, because again, this is kind of I would say the corridor where defense spending happens a fair bit. And finally, my point, again, I'm not a sector specialist here, but I think globally there is a push towards increasing defense spending. And even going towards this budget, we were anticipating, if I remember correctly, it's about 17% increase in the defense spending that has been put in the under the capex numbers. So that push is going to continue. I think everybody wants to strengthen the defenses, and partly locally, partly also build enough equipment. So I think that is likely to continue. Yeah.
So, okay, just to again sharpen the bit, while the focus is also to indigenize, would trade agreements come in the way? Because then essentially, if you're reducing tariffs, you're sort of, letting foreign manufactured goods come directly into India and vice versa, so that you don't necessarily have to set up shop. Is that sort of somehow linked? Would that be coming in the way to setting up manufacturing from offshore countries, or they're completely delinked? It won't be affected so much by the trade agreements with the two major blocks we have now, with USA and prior to that with the European Union. Mr. Modi, if you could address that.
Tell you the way whatever reading which we have done on European Union trade deal and what is emerging from the India-US trade deal, the way it is coming out is that the trade deal are facilitating a manufacturing hub and a partnership at India level so that it's a win-win situation for both. For example, let me say, if it's a manufacturing of Airbus or Boeing, right? I think there is a corresponding discussion happening, and states are lining up for setting up the base at India level to indigenize some portion of the whole operation, which itself will be a huge boost to Indian economy and the manufacturing sector per se. So I would say that it's a mixed bag of both. I can't generalize, but in a larger framework, the free trade zone and the trade deal should complement the whole manufacturing push in the defense sector, if you're talking about a defense part.
In general, if you, I would say that, I mean, a lot of people are now looking at, for example, the general anecdotal noise around the European luxury cars, which now people are looking forward to saying, okay, they become cheaper because the tariffs go down. So would somebody want to buy, let's say, an Audi which is manufactured in Germany or the one which is manufactured in India? Because pretty much there is no difference if you do not have tariffs really. Does that therefore move
So with
how?
that, if we look at the detailing part of it, I think the segment where India has agreed are a segment where currently there are no Indian manufacturers who are impacted, first of all. Right? If we look at it from an India manufacturing perspective versus global, right? Second portion, what India can deliver to these global car makers is the cost efficiency portion, which will continue as it is, irrespective of the tariff, in my view, in terms of their captive production. Third aspect, this zero duty is over a period of next 10 years and limited to quotas which are there. So I think it has been a balanced act by the government, I would put it that way, where they have still protected the Indian manufacturers on their current setup, or the segment that we have in automobile manufacturing, for example, versus something which are not part of the current segment of Indian manufacturers, and in that limited fashion they've allowed that.
Okay. So coming to, talking of, let's say, the partnerships that we are looking at with foreigners, and that's a segue I want to take towards another aspect that KPMG is covered quite a bit on, and that is the aspect of, you know, tax dispute resolution. I mean, we are infamous for the kind of delays in tax disputes that we've seen, and from a foreign perspective, I mean, who can forget what happened to Vodafone over years, where they faced a retrospective tax which went on for years, and now it appears that the government now wants to look at tax resolution at a quicker pace, where they want to look at some mechanism of resolution quicker from that perspective. And we were looking at some of the reportage from KPMG, where they were talking of large number of cases which get stuck at the before the resolution, or it continues lingering on. So something on that aspect that you'd want to sort of discuss with us
Sure.
from that.
So I think that is one area where we have some runway to cover, if you ask me. Right. So, for example, our survey said that 90% cases are stuck at a CIT appeal level, for example, right? I think the framework which needs to be done is that the way there is a framework for filing of the tax return, there has to be a framework for disposal of the appeals also. Today, there is no framework where within a time frame a CIT appeal needs to dispose of a particular case, right? It takes 4 years, it could take 5 years. The critical one specifically. If they are provided a runway of say 1 year or 2 year time limit by which they have to dispose of those cases, I think that will do a much good in a very long run. Because today, if you are talking about indemnity, and when you're doing a transaction, indemnity goes to 15 years, 12 years because of the whole litigation process. 4 years at the CIT appeal level, then there is a tribunal, then there is High Court, then there is Supreme Court. So by the time you reach to a resolution which you don't know what it will be, you are like 12, 15 years away. So I think if that is framework is predefined, say 5 years, 6 years overall, and broken into each authority, that will eventually do a lot of good to reposition our image.
Thanks. So, I mean, that was a critical point we wanted to discuss because that's been a thorn in the way for a lot of people looking at India as a destination because of the past experiences. Uh, Radhika, if I could take this to you, does this aspect worry international investors in some way, or from the way the tax treatment has never been a little not been so consistent, or it's not even a point of discussion now?
Yeah, I'll keep this input a bit short. So we ever so often have a couple of names and couple of companies that come up in very much in discussion, especially if the tax liabilities were uh, probably 5 or 10 years behind, and then some of these is sought after now. So I'm sure we don't want to discuss any names here, but so that is certainly, I would say, when we started talking about the ease of doing business, one of the legs is certainly the regulatory framework and the tax certainty. So I think there has been some instances. So very much. So answer your question, I don't think this is something that's going to die down so soon. So we are going to keep sharp. I think this focus is going to continue to sharpen as we go along. So tax certainty is something that typically does come up, I would say, in the dashboard that foreign investor would have when they're making investment decisions anywhere, right? Besides governance, I would say tax certainty, regulatory aspects, as well as operating environment. These would be some of the top of the mind for most of the investors, foreign as well as local.
Okay, thanks. Uh, so getting more towards the looking at the macro side of the business. So, off late, it appears that between last year and this year, the focus has been to place more money in the hands of investors. So, to that extent, the tax rates have been reduced. But at the same time, the government seems to be looking at a balancing act where fiscal consolidation is also a critical piece. So, you can't let go of too much. Uh, so, do you think on both sides they will be able to sort of make up for it, which basically then for means that the spending might reduce from the government? It How does this really play out, Radhika, to you?
Sure. First of all, to answer your question, this is certainly a very important, I would say, conjuncture, right, where one wants to spend well and spend quality expenditure, and at the same time, revenues also need to keep up. And in the past year, we have really seen that there's been a shift in the playbook that the government has followed, which is to not only do a supply side push, but also do a demand side support. Indirect taxes, case in point, then direct taxes, which are announced in last year's budget. And I think apart from just the government doing, there's also the central bank, which has been cutting rates and trying to ease, financial conditions. Right now, it hasn't really played out, but we do hope that all of the cuts that have been undertaken show through the financial conditions. To come back to your question, so it's a difficult act to keep up. So I think where the balance has been is that, especially if you talk about the budget in the context of the budget and fiscal 27 math, actually the government has undertaken, at least in the central government level, very, I would say, conservative tax assumptions. They haven't assumed very strong recovery in tax collections, especially direct, indirect. So if we usually use tax buoyancy as one of these indicators, and tax buoyancy has actually been kept below 1. That means if the economy grows by X number, they don't expect the tax revenues also grow by that X number. In fact, they expect it to be weaker than that. So, which is again conservative. So anything better than that will be good for the budget math. So that's one. The other one that they've done is on non-tax revenue, especially from divestment, they expect a bigger pickup. Right. So there are some assets that have been put on the block. So hopefully those will go through. And the third leg is what the RBI, PSU, by way of dividends, by way of profits, the money will come in. So that these are the three big chunks of revenues generally. On the spending side, I think there has been a bit of a rationalization in the sense that the revenue expenditures, that's the part where salaries, pensions, interest payments, these are things that happen ever so often. They're recurring expenditure that's been increased by lesser amount than the capex, which is actually high quality expenditure. So on all the parts, you can see that there has been kept in mind the overall framework, which is to keep fiscal consolidation very much in place. The second aspect of this is from here on, we are not going to see very, very aggressive fiscal consolidation. I think that's the part that I think all the market participants are going to increasingly come to terms with. We were at 9% deficit during the pandemic. We are at half of that now, meaning in 4-5 years, the math has been compressed very, very aggressively. But here on, we are going to see very, very small. Certain years, we might not even see any consolidation, right? It could just be the same deficit taken to the next year, because the focus now is not on deficit, but on debt. A country carries sovereign debt. I think the central government is very focused on bringing that down. I think so, kind of shifting focus to the bigger agenda, which is deficits are fine, but if the debt levels are not coming down, that's a problem as well. So I think, and you can see many of the developed countries now, Japan for one, US for another, UK for another, when debt levels go up, the borrowing cost also tends to go up, right? So I think that's what India wants to avoid. So that's where it finds that balance. So two takeaways, I would say. One, the shift in target from purely deficit to debt. That's number one. And the second one is we are not going to see aggressive consolidation here on. I think between years, some years there could be no consolidation and some years there'll be very small. That's the path that we're going to find ourselves in.
So, yeah, so while they're trying to have this balancing act and they're also the government is looking at making India a fairly attractive investment destination, there is also this effort to sharpen the focus on getting the offshore investor into the picture. So, one, they've tried to, increase the permissible limit in terms of the investment to the NRI. There's also some effort to try and decriminalize any kind of omissions by getting this foreign asset disclosure scheme by way of, getting. Do you think some of these efforts that they are putting in are making it attractive to the NRI investors? So, let's say this question is specifically to Mr. Modi, that would that sort of make life easier, or there are still a lot of misgivings that cohort of investors have towards investing or getting money into India?
So I think there are no one answer, but this certainly helps. I think from whatever my informal interaction with few of the members, it was there was one discussion which was going on, which is a continuous sell-off of FIIs over last 2 years, and I think Radhika would be able to address that more better. But they wanted to create a parallel hedge, if I may say, and they figured this community is something which can reasonably, because there is an abundance of capital which is available in the hands of this person who are non-resident out of India. Uh, and increasing that limit from 10 to 24% is a significant step towards that. That certainly, and look, today the capital market has demonstrated over last 3 years that the Indian capital market is today something which everybody is looking forward to. If we look at a decade before, everybody was looking at externalizing their holding to do the fundraising at US level or at a Europe level, where they would look at listing. Now, every second or third startup or new companies are looking at folding it into India and going off with the IPO at India level. So that is the strength of the capital market which has been built up. And to further accelerate that, they've increased this limit for NRIs from 10 to 24%, which certainly will help in the overall flow. That's my point of view.
And about the foreign asset disclosure, does
Yeah.
that sort of help in that? to that
Certainly, it
effect?
certainly. So we know a lot of families and lots of people who were earlier non-resident, now they are resident or vice versa, and they are filing return at India level, where this whole disclosure of foreign assets and everything came very recently, 4 or 5 years down the line. But earlier nobody used to disclose, and that was not required. But now that compliance is very clear under the Income Tax Act, they are giving a one-time like a disclosure scheme, voluntary disclosure scheme, where they are saying, look, if you have not disclosed any stream of income or you have not disclosed any foreign assets in either of the situation, by peace of mind, this is 30% tax and this is 30% penalty. Pay this, and there are no prosecution, there is no criminal aspect which comes into picture, and you are above the board post that. I think that's a huge step. It's a very welcome step. From our interaction with so many of the non-resident, they are looking forward. Of course, the final print is yet to come in terms of how they are going to disclose and how they are going to value and so on and so forth. But I think that is some step towards again bringing back what it's supposed to be rightly to disclose and encouraging people to come on terms with the compliance aspect.
Okay, thank you. But so coming now to the aspect of one more tax change, which probably was a little bit of a disappointment for the capital market participants, or it is a mixed bag, which is they increase the capital, they sort of increase the STT rates, and people were hoping all kinds of things around capital gains, and nothing really happened there. Now, increasing the STT looks like a step towards trying to curb speculative trading, but that is part and parcel of financial markets. Do you think it is a step in the right direction, or do you think it's not going to have so much of an impact?
Samir, honestly, just before the budget, there was a Supreme Court decision in Tiger Global, which has anyway shaken up the non-foreign investors, where they have challenged the treaty and gone to say that substance is what it matters, and they have disallowed and levied capital gain on that. So that is one discussion which was already hitting all the foreign global institutions. And to top it, there was some expectation that India is the only country where FIs are taxed, capital gain is taxed. And forget removing it, they have increased the STT and they have not made any change in the capital gain. So keeping in line with all these three events, obviously there was a lot of discomfort with the investors, global investors, that we were expecting certain things. Having said that, while it will certainly increase the hedging cost for institutional players, I think uh, the larger intent, which has been told again and again, is to ensure that the new generation, they're trying to just protect them in terms of getting into the speculative mode. If you ask me how the Gen Z works, point 2, 0.02 and 0.05, will that stop them from speculative trade? I have my doubts on that, but this is what the government has thought in their wisdom.
Okay, uh, thanks. So the other aspect I want to discuss, while discussing the overall uh, acceptability and attractiveness of Indian markets and the investment landscape, while nobody can take away from the fact that it is one of the fastest growing large economies, but of late what we have also seen has been the volatility in the currency and the strong depreciation that we've witnessed. Right. So on the one hand, from an equity perspective, it is genuinely an attractive destination, but we've seen mixed bag performance of late, particularly the calendar year 2025. And then it sort of ended up with very, very sharp devaluation in currency. Radhika, if I could come to you, from a investor's perspective, does this scare the investor from while the macro case is perfect, but markets is another aspect of it. Uh, do you think the return of large capital flows are still away from the Indian market, or how will that play out now with the new calendar year?
Sure. So on the currency, I think what you've seen is a shift on two counts. I think if you again take a bit of a historical reference, I would say 8 to 9 years, there has been a shift in the intervention strategy, right? Earlier, the intervention strategy was to keep dollar rupee. If there are any flows that come in, and these were flows where the equity market as well as the bond market were seeing very strong inflows. The official preference was absorb these flows, build the FX reserve buffer, and let the dollar rupee go higher or rupee weaken, right? Then we came in 23-24 when the intention was to keep the currency in a very narrow range and keep volatility cap, basically contain volatility very, very strongly. I remember a time when dollar rupee volatility was like dollar Hong Kong, right? The Hong Kong dollar is pegged currency. So both the volatilities were actually very close to each other. Then come 2025, and I think what the initial intention I would say was to let the rupee adjust to what the environment at large was. So you did see a pocket when dollar rupee actually went down, meaning rupee appreciated earlier in the year. But then came a host of headwinds, right? We did not see a US trade deal in time. We're actually seen outflows from the equity market, and we also at the currently saw a shift in the tack in terms of how the intervention was managed. It was very sporadic. There was not one preference in terms of whether they were trying to protect the downside or the upside. Now, fast forward to now, I think what certainly, so coming back to your question of foreign investors, certainly, right? They would look at, say, if it's a foreign investor, they're always looking at dollar hedged returns or dollar adjusted returns. So if we look at on dollar basis, the equity index, in fact, has not done much in the past 1 year, right? It's been more or less, I mean, there've been swings, but it's more or less been flat. If you're, so you're, you would typically have not made much money adjusted for the rupee. Going forward, I think what the rupee has been allowed to do now is adjust to macro realities. Current account trade is no longer the problem because goods is a big trade deficit, services is a big trade surplus. It's kind of matching out. I think where the issue is capital flows. If we want to finance a 1% gap in the current account, we need sufficient financing flows. And I think that's where the biggest gap is, portfolio and net FDI. This is typically where the issue is. So one way to do it is to artificially contain the currency, or the central bank will be spending a lot of money and ammunition. I think they see reason not to do that at this point. I think they just want it to adjust to where it finds its own level. Now, in the very near term, because the trade deal, so one big headwind gone because of trade deal. Now India's rate is in fact even better than some of the ASEAN countries when we look at the nominal level. So that's you've seen a bit of relief in the rupee. But longer out, I mean, as a house view, we still have a view for further rupee depreciation, very measured, but we do expect for competitiveness reasons, for again adjusting to where the flows are, bit of a free rein on, especially on the weakness, is what we expect. And at the last line, I think we are obviously looking at a lot of dollar rupee. We keep the dollar on one side and rupee on another and see where the exchange rate is going. But the rupee has been weakening against most of its trading partners. And the biggest one is, of course, the yuan, the Chinese yuan, right? So it's been depreciating against that currency as well. So net, I would say I mean, as a research view, we are looking for a bit more depreciation in the rupee during the course of 2026.
Okay, the last part that I said, therefore, the capital flows back into the market will then probably have to wait for a while because everybody will then look at getting in when they see more stability. And if one were to have a consensus view of more depreciation, is that what you're implying on the foreign cash flows coming in?
See, for foreign investors, a falling rupee is nothing new, right? I mean, typically, I mean, if you ask any foreign investor, I'm sure all of us have met some. They function on hedge basis in most of the markets, and in India in particular as well. So that's just one aspect that might keep fresh flows from coming in, but that can't. I mean, rupee falling is not the only aspect that typically, will will make a investor invest or not invest. I think in the last year, there's been a thing about regional portfolio adjustment, where there have been specific themes that have been in vogue, where, India's index construct doesn't have those themes. There's been a thing about looking for reasonable valuations, which India's, our basket was a bit different here. And finally being the corporate earnings, right? Do we expect single digit or double digit corporate earnings, and somewhere else it looks even better? So it's been a bit of I would say, a relative play. A weaker currency is but one reason, but I don't think that's the primary reason why a foreigner would decide, let me go in or not let me go in. They usually, I think, in their books, 3 to 4% depreciation is kind of already, built in the mind. It's everything else, whether adjusted for all of that, it makes a conducive play or not. I think that is what has been the, the direction in 25. And I would say 26, you can kind of, if you take a cues from the US markets, you can see that the rally is actually broadening out from very AI to non-AI, bit of industrials, bit of consumer goods. If that continues, I think then India, I think, will also find a lot more interest when the drivers behind the rally are just not tech names, but are non-tech names as well.
Okay, so taking segue from there, you hinted towards the drivers, and one of the drivers in the past that India has seen has actually been the government infra spending, and you know, government spending in general, and large part of it was really infra spending. Do you think that sort of is a critical element which will also keep chugging along to help the Indian markets, or do you see anything else emerging? I'm taking a cue from also a question raised in the, from one of the participants saying, what are the risks and opportunities therefore in the Indian market? So, will government spending be one critical element, or there are other things that you are seeing that are emerging which could create opportunities for investors in the market in the current ongoing year from the direction that even the GOI is laid out?
Yeah, I mean, infrastructure play certainly helps. I think I'm not the right person to say whether that will be the sectoral push or not. But I mean, with growth, one of the indicators usually, again, from a macro point of view, is the nominal GDP, right? So last year, India's nominal GDP growth was about 8%. This year is expected to go about 10%. Now, 10% is usually the rate, again, that is taken as a proxy or as an indicator of where the corporate earnings are going to be or corporate profitability is going to be. So we're going to see an increase from 8 to 10. So again, a big positive from an earnings point of view, from a company performance point of view. For infrastructure, certainly, I think it helps overall sentiments, business, operating environment, all of that benefits from putting into infrastructure. Of course, if there's a strong push, I would say that could become a theme as well. And I think on a theme front, just like Mr. Modi mentioned, there are a lot of other things. There's a lot of sectoral push that has come in. I think betting on any of that, on healthcare, has also become, geriatric care seems to be also another thing that seems to have gotten attention. Textile players, defense. These are some of the things where you can draw parallels between what the budget has done and what could be an interesting theme to work on. Again, this is just on the top of my head. So these are some things that I would say. And one of the other questions I saw was also on the consumer, on the rural consumer. So again, rural consumer and its play, because if you see the allocations towards a new version of Manrega, no longer Manrega, but it's a newer version now, all of that has also gone up. So do you want to bet on the health of a rural economy? That's another, again, a consumer durables, non-durables mix that investors might prefer.
Sure, thanks, Radhika. And so I'll just open it up a little bit to both of you. Mr. Modi first. We've also seen the foreign trade agreements, and it's a little early days. While nobody knows the fine print in detail, maybe people are beginning to study or whatever is on the table. I think the one with USA is still being negotiated at the finer level. What, in your opinion, since you may have a little better understanding of the entire ecosystem and what it entails, what are the quick takeaways where India will clearly benefit overall, or some sectors, some things very clearly will stand out as benefits to India, despite, let's say, the 18% tariff and whatever is it with the EU, and what really doesn't seem to change too much and is business as usual for us. And and the final thing which most people will typically, the skeptics will typically tend to raise is, are we even protected enough on the crucial critical sectors, typically the agri, dairy sectors, etc. for us? So over to you, Mr. Modi, and maybe even Radhika, if you could, chip into how do you see it?
Samir, uh, while, as you rightly said, the finer prints are yet to come, and the final go ahead will happen when it happens. But the way, whatever we have read up till now, the details which have emerged, right? I think government has done a fine balance to understand which are labor incentive industries and MSME industries which needed a cover or a protection. For example, textile and footwear, they have been, up with the government for a long time, and the tariff really impacted that. So I think whether it is carpet manufacturer, footwear, textile. So I think that is something which is really good considering the competition with Bangladesh, Vietnam, and other countries with US. And US continues to be the dominant player for us in terms of trade surplus, whatever we can achieve. The second aspect in this whole negotiation, if we again uh, look at the way the government has gone about, you mentioned about protecting dairy and agri. From whatever little we have read and what has been announced, we believe that all the essential agri products or a segment within the agri aspect have been covered and protected well, and probably where we don't have a dominant space in the agri sector is for those areas where they've probably opened up to for US side. So looks like it shouldn't impact uh, any of the Indian manufacturers or suppliers who are in this sector, the way it is emerging. From a, I mean, and then there are some things where Radhika mentioned that the government has been consciously sectors focused to say that where do I require a push? This push is required to protect my employment because it is labor incentive. There are some sectors which are required to be protected because of sensitivity like agri. So they have done their bit and looks like they have done their bit. There are some sectors which requires revamping like defense and all. So I think that is where also they have tried to say that we have to be technologically uh, at a latest level, and which is where we will require certain technology to come into India. And for that, if we have to provide some initial concession, so be it, but let's get to that level or start to get to that level. So I think it has been a very sector focused push and initiatives from the. So let me give you one example at a micro level. I was having a conversation today with one of the entrepreneur in the morning. So one small policy push which the government has given is on the infra side, that they will look at asset monetization through REIT, InvIT or whatever, right? And some level of monetization is happening at India at a ground level. For example, railways. I'm told that the kind of freehold land which railways own is unimaginable today. And the estimate of government revenue over a period of 1 decade, next 10 years, is expected to be around 3 lakh crore plus, purely from the land monetization from the railway authorities. Now, imagine defense. If they move to defense, defense is the largest landholder in India. If they pursue the same aspect, I mean, there are ways where they have started to generate revenue to have that cash inflow, capital inflow, to meet the fiscal requirement. So I think these are the things which are happening on a side by side, apart from this whole larger free trade agreements or trade agreements which are getting made. Radhika,
Radhika,
over to
your
you.
bit on this?
And I think Mr. Modi has really highlighted the very key points. I'll just add a couple of more. Again, I'll give a bit of a comparison because what you have seen whole of last year. So, India began negotiation, not talking about the BTA back in February of last year, right? So we are at the 1 year mark now. Then came reciprocal tariffs, and then June, July, and then in August was again another set of rates that were announced. Many of the countries did rush into signing trade deals, and what you see now is that they're doing backward work, right? So now they're going, after signing the deal, then they're going to the nitty-gritties and trying to finalize and get some concessions on resources or on particularly their own main, I would say, export categories. In India's benefit or not, I mean, what has happened is that the negotiations and the fine print have hopefully been worked on by the time the first tranche has been signed. So perhaps exactly the way trade deals should go, which is not should be in a rush and then do a backward integration later. So from that point, and if you see the EU one where more details are available, and you see that in the fine print is everything will happen, but will happen in a phased manner. Mr. Modi spoke about the auto sector. They're given anywhere between 5 to 10 years concession. I think the US is kind of like one of the provisions, for example, which I find hard for it to be reached, is this thing about India having to buy $500 billion worth of purchases. Right now, last year, it was 50 billion. So, in 5 years to get to from 50 to 500 is a mammoth task. Even if you say you're going to buy a lot of aircraft, you're going to buy a lot of defense equipment, it's going to be very, very difficult to reach that mark. So I think some of the announcements that have come in, more granular details are likely. I think it's going to be spread. The fact that India needs to open its markets to US imports also going to be a bit phased. It will differ sector to sector, and it will also be in a bit of a phased manner. So I don't think it's going to be a sudden opening, which is going to be very difficult. And the final point I'm going to say is that this, to my mind, is still a conditional waiver, right? So there is one trade deal that is being signed, and there's another executive order. So even the mechanisms and the structures have actually been very different. So we should be mindful that it's a conditional waiver in terms of how much India is able to buy. Is Russian, oil purchases going to come down? I looked at 24 numbers and I looked at 25 numbers. To 2021 was extremely small. It was about $3,000 worth or $4,000 worth of imports that India had from Russia. It peaked at about 55 billion worth, and now we are at about 44 billion worth last year, right? So it's coming down. But is the speed considered fast enough? So all of these are fine prints and things that would make people a bit circumspect. But I think for the time being, it's a big overhang that has gone past. I think that's what the economy is going to take and run with, and the markets are going to take and run with.
Thanks, Radhika. And one final question before we sort of wrap up the webinar. So, from both of you, are there any headwinds for this year? Any things which are risks that one should be wary of as an investor? Of course, there's a lot of good positive things that are helping India. A lot of tailwinds. The FTAs, the budget perspective, the fact that markets are also valued better. So, from an investor's perspective, but having said all of that, what are the few areas one should be mindful of? Any risks in the picture that you would kind of highlight or be at the back of your mind? Mr. Modi first and then Radhika.
I was hoping this time Radhika go first, but okay.
I'll leave it to you guys.
I'm going to be none the wiser when my turn comes. I'm still trying to think.
No. So let me. I don't know in terms of how to put this across, but I guess again we are seeing a very different push and incentivization based on each sector, which if we look at it, and I would say that we have to choose what we are looking at getting into from a sector and overall policy perspective. So I think if we look at last few years and the current year, including the current year, uh, there is a pattern in which the government wants certain sector to develop, certain investment to come, or certain talent to uh, pull certain talent in certain sectors. So I guess there is a lot of available lot of opportunity in tech, AI, and that, which is a clear push, cloud service and all that. There is a second push which is going in terms of manufacturing, including semiconductor, including defense, and so on and so forth, which is there. And third is the labor incentive part of it, where they're trying to more protect and get a favorable tariff protection as far as the Indian manufacturer goes, whether it is gems and jewelry, footwear, textile, and so on and so forth. So I think that is the larger basket, the way I'm envisaging it. Now, the risk is obviously that up till now we have seen, by and large, from a policy side, a largely stable policy-driven thing. It may take, certain things may take 5 years, and certain things may take 2 years. So I think we have to, I mean, anybody who's looking at investing has to take a little long-term view, considering the disruptions which are happening again and again every 6 months. But it does flatten out if we look at a 5 year horizon or a 10-year horizon. So that's how I would say. From a tax landscape perspective, if I have to answer, I think we have moved from an era to a new era of faceless assessment. Now it is getting settled and being accepted by a lot of corporates. The corporate rate rationalization has happened, and we have one of the lowest corporate tax rate. So if there are lots of safe harbor rules which have come up again to protect the GCC delivery centers and all those things. So I think number of things are getting streamlined. Uh, yes, certain areas where we still have a runway to go is in terms of how do you reduce the litigation, how do you create a stability so that there are, so government has done a fairly decent job now of late to ensure that they are not they're not giving shocks with retrospective amendment and all that. Now, if we move to a next phase where they are giving a clarity for next 10 years of policy from a tech side also, that will go a long way. And I think uh, my only summary would be a long-term view over a short-term benefit. And that's how I will like people to evaluate, or the investors to evaluate the overall situation.
Thanks. Radhika, your last word and before we wrap up.
And I was just thinking, Samir is even thinking about headwinds. I mean, I don't know what we've been doing in the past 1 year. It's been one after the other. And in fact, most of our discussions nowadays seem to start with it's only January or it's only February. And, we've got so much activity on the hands. Taking on the cues from Mr. Mody, I'll probably give two external and one internal. I think to me, two external could be one, geopolitics going bad. For one thing that matters to India, which is energy prices. It's been a very benign environment for the past, I would say 3-4 years. Even when Brent went up, India had Russian oil. So I think that was a very conducive external environment for India. So I think oil prices is something that we'll be watching very closely. The other one external would be general risk aversion, I think, which can delay further the return of real flows as well as portfolio flows. I think I would say that would be the number two. And internally, I would say one part of the economy that has been functioning very well is rural, and within rural is farm rural. And we've had 2 years back-to-back good monsoon. So, if typically in the past we haven't seen a third year, consecutive year. So that would be something that I could, that could be a problematic development, which is one hit in one monsoon, and then it has repercussions for not only summer crop, but the winter crop as well. So I would say two external, one internal would be something I'll watch out.
Sure. Thanks, Radhika, and thanks, Mr. Mody, for that perspective. And thank you to all the participants for having been part of an interesting and a very insightful session we've had with these two expert personalities. And it's been very enlightening for us to get that perspective on multiple things that have happened. And I would like to extend our thanks to both Mr. Mody and Radhika Rao for having given us this perspective. Thank you very much. I would like to wish all of you a very happy and a very good day ahead. And as we close this session, thanks to all of you. and have a good
Thank
day.
you very much.
Thank
Have a
you.
nice
Thank you
evening,
very
everyone.
much.